And so here is how we need to sort of modify what's going on the GAAP balance sheet when you have a stock sale, something legally structured as a stock sale. You have this PP&E write-up of $100 million, and that creates, as we mentioned, a $40 million DTL. And now you no longer have a $100 increase in equity. If you recall, and I'm just going to go back again just to refresh ourselves on what we did when we did the purchase price allocation exercise. Recall that when we wrote up this PP&E, that has the impact of writing up equity, right? If all of a sudden you realize, hey, your PP&E is now worth 300 but worth 400, well, your equity is now no longer worth 400 but it's worth 500, right? But here what we're saying is, in the event you have a stock sale, in the event the deal is structured as a stock sale, you don't actually write up equity one-to-one with the PP&E write-up. And that's because this increase corresponds with higher taxes relatively to what you're going to show for book purposes. So you don't write up your equity by 100, but rather by 60. And the remainder is a deferred tax liability. And so at this point, total assets and liabilities, of course, go up by 100. Debits do equal credits. And the answer is yes, assets equal liabilities plus equity. Now, what happens going forward? So you created this deferred tax liability. And going forward, what's happening to cash here? It's simple enough, we can kind of see. On year one, what's happening to cash? Well, since this is a non-cash expense, we've got $500 trickling down to the bottom line. You paid $140 in taxes. So $360 is what's happening to cash, right? We didn't build a cash flow statement. It was kind of unnecessary because it's just more complexity than is merited given how simple the numbers are here. $500 in cash. And remember, I'm looking at the tax returns because this is actually what you pay in cash. So I'm trying to figure out what is the impact to cash. It's 500 minus 140, 360. So let's add that. So we have cash going up by 360. What's happening to PP&E? Well, PP&E this is your book balance sheet. But the book balance sheet the book balance sheet cash line does not lie, right? So cash purposes, the cash amount on the balance sheet we have to recognize correctly. Then the PP&E, what's happening? Well, you wrote up your PP&E to 400. And now you depreciated by 200, right? Your deferred tax liability went down by 20. Let's make sure we understand that. Why is it going down by 20? Well, because at this point, this is our frame now. So our frame is now, we have 1 year left. Well, at this point, we have a deferred tax liability only of 20 because we know that this year we're going to recognize 120 in GAAP taxes, but we're going to have to pay 140. There's no longer a $40 cumulative liability, but the liability's gone down because there's now only a $20 million cumulative liability left. So hopefully that makes sense. So this is going down because you recognize the cumulative liability up front and then you're reducing it. Now, what's going on the equity side? You have to go to retained earnings, right? So retained earnings goes up by the 180. So this is where the mismatch is. Right now I'm going to my book balance sheet and I'm looking at net income. Net income is what increases my retained earnings by that 180. And if I did my numbers correctly, my balance sheet balances. We're going to just deal with that ugly handwriting here. So that's supposed to be a 180 minus 20 plus 180